Welcome everybody to Stock Talk with Nico Kritikos. Today we're going to be going through Take-Two Gaming stock, which is a $14 billion company that specializes in different types of games like NBA 2K, Grand Theft Auto, Max Payne, and many other famous names. So if we look at the stock chart here, we could see that the ticker is TTWO, Take-Two Interactive Software. And as with most stocks in the market, this stock has been beaten down the last couple months. It peaked out last November at $192 a share. Today it's $119. So if we get started with my checklist, we can see that once again, they are a creator of games like Grand Theft Auto, which Grand Theft Auto 5 has sold over 145 million sales. We have other franchises like Max Payne, Red Dead Redemption, BioShock, Borderlands, NBA 2K, as well as the WWE series and the PGA Tour series. So one thing they mentioned in their 10K is that they're investing into mobile gaming, and that is their fastest growing segment. So they're making acquisitions to trying to capitalize on that market. So if we get started with my checklist, the first one's going to get a yes, of course, because the stock is down over 30% from its highs. Is the revenue and net income increasing? Yes. If we check out the revenue and net income, I think they've done a great job over the last couple of years, going from 1.4 billion in 2015 to 3.5 billion in 2021. Earnings have gone, from 173 million to 300 million, 400 million. 2020 they did 588 million, and then earnings came down a little bit this past year, probably just because of the pandemic. Created a short-term thing where so many people were rushing to get games and they were forced to stay at home. So of course that was going to increase demand, right? If we go to the next thing, we can see that they do have a healthy price to sales, and that is a price to sales of 4. And in 2023, they're expected to have 33% revenue growth, which is really good. That is a great sign. For price to earnings, we have a forward PE of 22, and in 2023, they're expected to grow EPS by 67%, which again is a fantastic number. That makes it look really undervalued. Next up, I put a yes for that they are innovative. They do have a moat. I believe they did a great job making those series like Grand Theft Auto, like NBA 2K, Red Dead Redemption. Those are all series that are, have done incredibly well over the last 10 to 15 years. And I think that serves as a big moat for the company, because not any company can just come in there and make a extremely successful brand or extremely successful franchise like Grand Theft Auto. That's something, they've created a reputation for themselves that isn't hard to, or isn't easy to replicate, right? So then next one is the industry growing? I put yes, the gaming industry is expected to grow at 12% a year. And then we have return on invested capital of 52%, which is incredibly good. So that's definitely going to get a yes. Number 9, do they have healthy margins? 12% is fantastic. That's going to get a yes. Cash flow is going to get a no, because if we take a look here, we can see that it's not the best. So their end cash position has been getting better. I will say they have a great balance sheet, but their operating cash flow fluctuates a lot. And this past year, it's really a lot worse than where it was in the last couple of years. And so that's a bit of an issue. Free cash flow does not look that good then. So operating cash flow, you can see, was up in the 800s, the 600s, the 900s of millions of dollars over the past 3 or 4 years. But this past year, we only saw 250 million. So that's a bit of an issue. Free cash flow was up in the 600s, 700s, 800s, and now we're under $100 million of free cash flow. So that definitely is not a great sign. I wouldn't call that healthy cash flow. Then we get to diverse revenue streams. This one was close, because you could, at first I was going to say yes, because they do operate all over the world. They operate with tons of different retailers, tons of different customers. But the problem I saw was when I read the 10K, it said that their top 5 customers account for 78% of their revenue. So the 2 big ones, it sounds like, are Sony and Microsoft. Those are some of their, so they are making their revenue from, big reliable companies. That's a great sign, but still that's a lot of customer concentration, with 5 customers accounting for nearly 80% of your revenue. That's a bit too much. So that's going to get a no. For their balance sheet, how I said, looks fantastic. So they definitely have more assets and liabilities. Their price to book is a 4, and their equity growth is roughly over the past year, 15% growth, which is going to give it a 0.27 ratio. And so that's just, it's their balance sheet is really nice. Then we have their equity, and their equity is about 27%, or yeah, their equity is about 27% of the market cap, which is very healthy. Over 10%, that's going to get a check. Then we have share buyback and dividends. They don't have a dividend, but their share buyback program is really nice. And if we look at the number of shares over the past year, we can see that it's pretty much been the same. It's pretty much been flatlining. So that's a good sign. That's good. Then we have our insiders interested. This one was in the middle somewhere. I put yes because over the past year, you can see there was lots of buying transactions, but they weren't at necessarily great prices. Like there was a bunch of buying going on when it was near its highs, and then we haven't seen much buying pressure the last couple months, but that could just be because they bought earlier last year, and then there were some sells there, so it's somewhere in the middle. And then finally we have, is the price to free cash flow under a 25? This is a new metric that I'm kind of experimenting with, but this one really is going to be more applicable to companies that are not huge growth companies. So since this one is a little bit more of a growth company, it's going to fluctuate a little bit more. So their price to free cash flow is 139, which again, that goes back to the cash flow statement of how I said the free cash flow does not look that great. It dropped down a lot. So, I have a feeling it's going to be a short-term thing. I have a feeling a year from now, 2 years from now, it's going to at least double or triple, and it'll get back to where it should be. But for right now, it does not, it's not in a good spot. And so, yeah, so overall we have a score of a 15 out of 18, which would be considered a buy. So I'm going to give this stock a check. It has my confirmation, but I have never owned this stock in the past, and I don't plan on buying it anytime soon, just because there's so many other stocks out there that are good opportunities. But I definitely would say this is not a bad investment. I think this is a good company to be invested into. And so, yeah, that's all for today. Thank you for watching, and I will see you in the next video.